It's all right as a founder, as a business owner, to take a little bit of money off the table. There are 3 ways that you can raise capital. The way the VAT system works is you're 1 day late for your VAT payment. It's not an interest, it's a surcharge, it's a penalty. You need to have some really, really solid forecasts. You need to have a really good narrative, a good business plan, everything that comes together. Would you rather have a smaller slice of a larger pie? Do you want the whole pie, but it's a smaller pie? What are the 10 KPIs that really tell you about the health of your business?
Welcome to the 80/20 Thought Leadership Series. I'm your host, Dylan Falvey, Managing Partner at SRG Strategy. Today, I'm joined by Jason Samuels, a partner at top 30 UK accounting firm BKL. We're going to dive into a really important topic today that impacts all businesses around the world, capital raising, and more importantly, the execution strategy behind the act itself. Having worked with dozens of businesses scaling across different sectors, Jason and I have seen firsthand what works and, more importantly, what doesn't work. Today, we want to share insights that will help you raise smarter, run better, and avoid costly mistakes that often come after the capital is raised. Jason, thanks so much for joining us today.
Lovely to be here.
So to kick things off, let's get straight into something of value for the listeners. What's one question every business owner should ask themselves before raising capital that most don't?
I think the most important thing to understand is, why are you raising this capital? Why do you need this money? There's lots and lots of reasons why any business could do with capital. I think from me and my experience in it, I think if you want to be taken seriously by investors, the 2 reasons that investors are going to want to see are going to be to de-risk or to grow. It's all right as a founder, as a business owner, to take a little bit of money off the table. It's all right to de-risk yourself a little bit, as long as you're staying invested, as long as you've still got skin in the game. Investors usually are all right with that. In terms of growth, you've got to think about, what are your investors investing in? What are they looking for? Are they looking for a long-term income play? Are they looking for a business they can be in for 5 years and exit for a lot more money than they put in, than they've invested in the first place? The only real way to get to that point is to grow. That's what they're going to want to see their money being used for. What is the strategy behind how you're going to get from where you are now to the point where they need you to be in order to realize the investment they expect?
Yeah, so defining that end goal and linking back to the rationale as to how more money effectively will enable you to get there. And I think timing is the other important thing, right? Is now the right time to do that? Not all businesses have to raise money. It certainly does help most accelerate it. And I guess, you have a lot of experience in doing this. I mean, would you mind giving the audience some background into yourself and your role as a partner at BKL?
Yeah, of course. So I am a chartered accountant by training. BKL are a professional services, tax advisory, accounting audit firm. As you said, we are on the cusp of the top 30 in the UK. My role has 2 facets. Number 1 is looking internally at our own growth. I have a lot of empathy with people who are taking investment. We ourselves are private equity backed, so we understand exactly what big corporate investors expect of us in order to achieve their objectives. The other side is looking after my clients. So I work with predominantly in the OMB space, mostly in property construction, hospitality, professional service businesses. We provide is anything from your normal accountancy. A lot is tax driven. We're a very large tax practice, and a lot of it's just trusted advisor sounding board. It's being there for your clients, where we as a business, we as a group of partners deal with these issues regularly enough that we've seen them and we've learned from them, and we can give that experience to our clients when perhaps they don't see them as frequently as we do.
Yeah, and I guess for the audience, OMB is owner managed business. In fact, Jason and I we have a very mutual client base in the sense of who we target and who we work with. So I think today's going to be a really interesting discussion. And I think the first, as you mentioned earlier, the first thing to ask yourself is, should we raise at all? And if we are going to raise, when's the right timeline? So my question for you is, have you seen companies raise capital too early or with the wrong preparation only to regret it later?
So it's an interesting question. And I think we need to go back to defining what raising capital means.
Yep.
So for me, in the way I look at a business, there are 3 ways that you can raise capital. You can sell equity. You can have someone invest in your business for a stake of it going forward. You can raise it by debt, whatever it might be, bank loans, asset finance, whatever it might be. And my preferred way is always you raise it by better leveraging your own working capital. By leveraging your own working capital, that's getting paid by your suppliers quicker, by minimizing the amount you've got trapped in work in progress, if that's what your business does, in stock, and getting more out of the payment terms from your suppliers. That's the cheapest way you're going to be able to raise money. There is no cost of doing that. Raising money from a bank, great. There's an interest, but the interest is fixed on the amount you borrow. Receiving capital for equity, you're giving away a slice of the future of your business. Going straight to that point is the wrong way to look at raising capital. There's got to be a really important transformation required in your business in order to justify that. And that does exist. Often you will find that there's only so far your working capital can go. Once you've exhausted that, you can look at debt raising, but the appetite of banks and other lending organizations might not be there to deliver the growth journey that you want for your business. That's where raising money through selling equity in your business will make sense. And there is a market out there for that.
Absolutely. Yeah. And I think a lot of business owners, typically in the small business space, not startups, but established owner-managed companies, a lot of them do have a bit of debt. A lot of them do take various bank loans or individual lender loans out. Actually, those are probably more common from what I've seen. And they typically get to a stage where they're a couple of million in EBITDA, and that's really what's made up their their business. And now they're looking typically at how can I get an investor in? I don't want more debt on the balance sheet. What do you typically explain the journey to me that you would take a owner-managed business through when they come to you and go, Jason, we want to raise capital. We think we need this much. What does that journey look like, and how should it be executed?
So the first thing we will always do with anyone looking to do that is we'd look at their working capital. We would look at how quickly are you getting your debtors? How quickly are your customers paying you? Your customers not paying you within your credit terms is effectively you lending them money.
Yeah.
Unless you are a money lending organization, that is not your business.
Yeah.
So we shouldn't be doing it. We should be putting in place proper procedures and processes to ensure that you are paid when you expect to get paid. We can look at your work in progress. We can look at your stock. We can look at what you're buying. Yes, all right, sometimes there's a nice opportunity to buy a job lot of stuff you're going to be able to sell over a few years' time, but you don't want to be overstocked. You don't want to have that money tied up when it can be used for other things. And creditors is the other thing. Where could you do better credit terms? Are you paying anyone on pro forma when you've got a really good working history with them? Should they be giving you 30 days to make the payment?
Yeah.
We'd also look at leakages. So this is where kind of bad financial management really costs you money. I mean, it's a story I've come across all too often with clients where the way the VAT system works is you're 1 day late for your VAT payment. It's not an interest, it's a surcharge, it's a penalty. That's a really expensive way of borrowing money. And the government, HMRC, are not there to lend you money. The banks might be there to lend you money. It's cheaper to borrow it from your bank than it is to borrow it from HMRC. It's these sorts of ways we can often find it might not be enough money for what you're looking to do, but it's the first point. It's the cheapest. It's free to raise the money this way. There is no cost of raising the money this way. Let's look at how we can better leverage your balance sheet before we look about what we can add to your balance sheet.
Yeah. And I'd love to talk later in the podcast specifically about mechanisms to do that. But let's say we've done our analysis, we've gone in, they're being paid on time, or in fact, they're not being paid on time, but even if they do, there's not enough capital there for them. Typically, they need money. In my experience, companies want to raise money for two reasons. One is they need to invest within, so staff, new resources, machinery, etc. The second one is buying another business. And, there are debt options out there for that, but more often than not, they need a bit of capital they don't have. So in those instances, what's the next step?
So at that point, you need to look at you need to have a really, really good understanding of what the growth you're hoping to deliver that investment is going to look like. You need to have some really, really solid forecasts. You need to have a really good narrative, a good business plan, everything that comes together so that you are ready to go out to investors to explain the journey you want them to come on with you.
Yeah.
There are investors out there who look at all sorts of opportunities. But it's important to remember with the investors is what are they looking for? What is in it for them? You need to make sure there's something in it for them. Otherwise, no one's going to give you the money. You've got to pull together this narrative, this story. Once you understand what you're doing, you then consider what sort of investors might be interested in that. Be it, obviously, depending on the size and what you're planning on doing. Is it going to be a family office? Is it going to be a business angel, a VC, a private equity fund? There are all sorts of these kind of opportunities out there, but you really need to understand it's your growth journey, not theirs. They are coming along for your ride. So you really need to understand what that looks like and be flexible with it.
Yeah, absolutely. And that commercial narrative, I think, is a really important piece. You've got to decide, what do you need the money for? Where is it going to go? What does the timeline look like? But you've also got to, it's almost, it's basically sales. Raising capital is basically sales, and you need to have that great pitch deck or investor memorandum there in order to justify it. And typically where I see people fall short is they kind of just give people their books and say, we need this money for this. Do you want to invest, yes or no? And imagine how much more compelling it would be if here's the narrative, here's where it's going to go. This has been, vetted by X, Y, and Z people. Here's the people on our board of advisors. It's a safe bet. And also making sure, as you said, you're going to the right person or institution in some cases, because strategic investors versus non-strategic investors is a big thing to consider. Often, more in the startup world than anywhere else, but often you get a strategic investor, they're going to give you a lot of advice for free. They're going to open doors beyond just the investor check.
Yeah. And again, the sort of investor you end up going to will also dictate to you what sort of control you retain in your own business. Do you want to go, and it's an interesting one, do you want to go out, say you've got an enterprise value of your business is worth, say, 5 million, you're looking to raise £1 million, so you're giving away a £5 million post raise, you're looking at giving away 20% of the business. Do you want to raise that from 20 investors for £50,000 each? Do you want to raise it from one investor for £1 million? Let's look at the pros and cons. If you look at 50 small investors, none of them have any sort of substantial right in the control of the company. Even if all 20 of them came together, you still have 80% of the voting capital of the company. You are in full control. One investor with 20%, they're going to have a little bit more say. They've got a little bit more right and opportunity to turn around and say, actually, we don't like the way you're doing that. Do you want? And it's a decision. There are pros and cons of both. Perhaps in the way I've said it, I'm saying that maybe having an investor that is interested is a bad thing. It's not a bad thing at all. Maybe they're there offering guidance, as Dylan, as you say, they're opening doors for you. That's a good thing.
Yep.
But it's something you need to weigh up about your own business. And if you don't want someone there with a say in what you're doing strategically or operationally, don't go out and find one big investor. If you want someone that's going to sit there and help you, maybe look for the big investor. Don't go to 20 small investors who, quite frankly, are probably just taking a punt.
Yeah, absolutely. I think if we take a couple steps back then, having control on your business, raising debt capital, or indeed just continuing to grow organically are the options where you retain that control. And I'm wondering if if business owners listening to this and they're considering, do we just grow slower but organically, or do we raise capital? How can they? Is there a framework they can employ, or is it just based on their appetite for risk? Because for example, I have one client at the moment now. They'd like to raise about €1 million. They're doing around 750,000 EBITDA. Their enterprise value is probably around 8 or 9 million. It's not easy to raise that capital. We can get the narrative together for them, but it's sort of like we can get where we would probably not get to for another 5 to 10 years in the next 6 to 8 months if we had that money, because it's for acquisitions, right? There's no other way we can acquire more businesses. So we're trying to establish a framework at this point as to how we can do that and how to justify diluting, because at the moment it's a 100% shareholder. And I'm sure there's a lot of people in that position right now.
Oh, there's an analogy here about the size of the pie and the size of your slice.
Yep. Yep.
We can go down that. Would you rather have a smaller slice of a larger pie, or do you want the whole pie, but it's a smaller pie? In the moment, there's no real right or wrong answer. Ultimately, I think if you're looking at growing through acquisition growth, what you need to be sure of is that your investor is investing into your dream of the combined business at a higher rate than you will be paying for your acquisition target. So in your example, if for 100,000 euros of EBITDA, you're paying a 5x multiple, but you've got an investor investing in your business at a 10x multiple, the pie is getting bigger quicker than your slice is getting smaller.
Yeah.
And it's in that arbitrage that acquisition growth will be worthwhile for you. Now, looking from now forward, it's very, very difficult to predict exactly where that will land, but you build sensitivity into the way that growth model works. You make sure that there is a market for you to acquire businesses smaller than you and acquire that growth at a lower rate than you're raising on your own business. And you are giving them a slice of that arbitrage with you, but you are retaining the bulk of that arbitrage yourself.
Yeah, that makes sense. I would say I've seen the bad side of raising money for the sake of raising money. You sometimes do have to give board seats away to investors, and they're not very helpful at some of the meetings because they're sort of shaking. Well, they've sort of got their hands out going, where are the returns, where are the returns, where are the returns? And I think that's what a lot of people don't see.
I agree with that, but I think that's why it's so important to get the narrative early. And what that narrative should include is what good looks like and when.
Yeah.
Because if you've been honest with your investors right from the start and you say, in year one, I am going to acquire one business and I'm going to integrate that business. And because of integration, my gross profit is going to fall. At the end of year one, when your gross profit has fallen and you are working through your integration of your now combined business, they sit and say, you told me that was going to happen. That's fine. I was expecting this. But now you've told them at the end of year two, integration will be complete and gross profit will be bigger than it was beforehand. As long as you achieve that in year two, their expectations have been managed. They knew this was going to happen. This is exactly the story that they were told, and you are delivering good.
Yeah.
It becomes a little bit more complicated when we have market shocks and, things happen. It's keeping to that narrative. You've got to, at the highest possible level, you've got to set their expectations for what reality is going to look like. No one is going to go out and buy a business and integrate it perfectly in a month. It takes time.
It takes time.
And you need to build that in, and it costs money. And the time it takes to get integration right will take all the senior leadership in both organizations time and focus away from business as usual, BAU we call it. It takes the time away from that. It's a balance. You need to keep an eye on BAU. BAU is what pays the bills. Getting integration right is what builds a growing business.
Absolutely. And in building that plan, again, working with businesses in this sort of 500K to 5 million EBITDA range, some of them do have great management teams and, very good CFOs or fractional CFOs and financial controllers, but I'd say the vast majority I've met don't. So if you're sat there right now as a business owner and you haven't got that capability, and you probably don't even have the bandwidth yourself to manage the capital raise, to draw up the right documents, to build that investor conviction with, this is what year 1, 2, 3, 4, 5 looks like. What do you do?
I use the term broadly, you resource. Do you want to bring in someone into your organization, a CFO that is going to have the bandwidth? CFOs are really expensive though. Do you want to bring in that at a fractional level? Do you want to outsource? Do you want to go out to professional service organizations that do this, that focus on this for small businesses? There isn't necessarily a wrong answer, but it's a cost benefit analysis for your business. What works for your business? How much time, effort, and money are you happy to deploy for this process? And something every business owner has to accept is it is going to take time, effort, and money going through this process, and then after the process, making it work.
And is there a size at which having an in-house financial controller makes sense? You should definitely have by X size.
It really depends on the business.
Yeah.
It depends on what you view the role of your senior finance professionals. So the way we view a finance team, you've got 3 senior finance professionals. You've got a financial controller, a financial director, and a CFO. The costs for each go up significantly as it goes through. Your financial controller is there to keep your record keeping up to date, to make sure you're filing what needs to be filed, paying what needs to be paid, collecting what needs to be collected, tracking what needs to be tracked. Your financial director should be the one that's leading a team. They might be looking not just at making sure your requirements are met, but looking at your forecasting, looking at what data you use in order to make business decisions. Your CFO, which is the one a lot of small businesses will not. It takes an awful lot of scale to get to a point where you look at a CFO. CFO is the one that should be leading in the financial strategy.
Yep.
They are the one that should be talking to you about not the minutiae of the data. They should be talking to you about, right, where is this business going? What are we building? Where are our opportunities? In organizations big enough, they are the ones that will be leading these fundraising processes. It's not for the CEO or the founder or the chairman or whoever it is that sits at the top of the tree to be doing this. This is the CFO's job to do. But CFOs come with very significant cost.
Significant cost, and also I think there's a more important discussion here, which is the information asymmetry that a business owner has, especially given that most haven't come from the corporate world and haven't experienced having a CFO before, which is there's too much trust, I think, put on, let's call it a strategic hire in the finance department. And, the 3 job roles you've just listed there, I typically find that's being done by one person. And it's being done pretty badly normally by one person. And the way that I see recruitment work in small businesses is you get recommended some form of finance person. They probably, and I see this more often than not, which is weird in small businesses, they've come from a corporate role, which means they don't even know how to run a finance department in a small business. And it is apples and oranges. So, that's where I think almost, I don't know if the word would be outsourcing or fractionalizing that responsibility is a little bit more expensive, but I think it's quite important to do, because if you work with a big firm, like yours, who have the capability and the track record to deliver, then that risk is completely mitigated. And I was only speaking with a client the other week, and we're in the process of doing that because tried and tested financial controllers, fractional CFOs, none of it is quite delivered. And the owner's now gone, look, I don't care what it's going to cost me. This is so fundamentally important to get right now that I'll pay whatever it is. I'll take it out of my drawings from the business. I've seen people go through the ups and downs. So, I think that's one key insight from this discussion today, which is you really need to invest in that function.
Yes, we have a fractional finance team offering. What we often see is that our clients of this sort of size will often have a finance team. It's usually 1 or 2 members of the finance team who'll split the role. Split the role and the responsibilities between them, which is absolutely fine, and they're on top of the compliance. It's not really an issue, and they're doing some kind of basic forecasting for the business owner. When these sorts of pivotal, transformative business moments come up, what we often supply is that project-based fractional finance role. So it's not someone that's going to sit in your business forever. It's very much someone that's going to sit there and say, okay, this is the checklist of what needs to be done in order to get you to the point that investors are going to invest in this business.
Yep.
This is the forecast. These are the stress tests. These are the various projects which need to be completed to get this deal over the line. There's 2 benefits to it being fractional here. First benefit is obviously that, yes, it might be a little bit more expensive than having someone in-house do it. However, you're only paying for what you need. You're only paying for what needs to happen. You're not paying for the dead time. You're not paying for the bits where you're not getting any benefit from it.
Yeah.
The second benefit is on something on a deal that we often like to call the add backs, because Dylan will agree with this. Often the way a business is valued is on a multiple of your EBITDA.
Yep.
And what EBITDA is used is your sustainable EBITDA. It's your real EBITDA. And certain costs you are allowed to sit and say, well, that's not really a business cost. That's just something that was a one-off. So we're going to exclude that from our EBITDA, and that's going to drive your enterprise value. having an outsourced fractional finance offering is one of the things that no investor will sit there and say
Yeah.
cannot be added back to your EBITDA. So it adds to your enterprise value.
Yeah.
So yes, it is still a cost. It's something you have to bear, but it's not going to affect your enterprise value as much as if you were to bring your finance team in-house for these purposes.
Yeah. I mean, I think for that capital raise portion, it's essential if you haven't got the talent to get the support for it, because as well as I think advising on that journey, it enables people to justify their decision. Because, I'm sure it's the same when you walk into a business, you do ask a lot of questions to just justify that what they've contracted you in to do is actually the right thing. And I do find more often than not, it's not. It's not the right thing. It hasn't been thought through. And then you kind of, unfortunately for your costs, yeah, it does open that other door that you have to go into and explore. But at the end of the day, you do de-risk significantly that decision. And I guess I'm just quite sick of going into owner-managed companies and seeing the wrong people running the finance departments, because a lot of people say, oh, well, construction's risky, real estate's risky, hospitality, oh, it's COVID, it's up and down. But a lot of the time it's mismanaged funds, right? It's mismanaged funds. There's no connection to the strategy and it's just a mess. And I think if you invest in getting the systems and processes behind that properly in order, you can avoid a headache further down the road.
Yeah, and I think we could probably go one step further than that as well. So looking at an owner-manager's appetite to risk, and I'm going to use the term quite broadly, but looking at an owner-manager's appetite to risk and looking at an investor's appetite to risk will be very, very different. And it's where we see a lot of deals not always fall apart, but it was where we see effectively a reduction in value of the business is where, as an owner-manager of a business, you might be happy to take a little bit more tax risk or a little bit more commercial risk or legal risk because it's your business.
Yep.
Because you're not under the microscope. But where you've got financial institutions, listed businesses, whatever it might be, possibly coming along, joining that journey with you, their appetite to these things will be very, very different. And it's often what we find in the due diligence process of these deals is something which was not an issue. Oh, and I'm not even saying not perceived to be an issue. Something that was not an issue to the owner-manager of the business is an issue to the investors. And sometimes understanding that and understanding, I don't want to call it your skeletons in the closet because they're not your skeletons in your closet. It's just where you've made completely legitimate business decisions that for reasons which you never would have perceived at the time are not what an investor would have done, causing a bit of an issue. And it's about understanding that. And if you do have a business that carries a lot of this risk, perhaps financial institutions are not the right investors for you. Or is there something that can be done to tidy up these affairs to get through that level of scrutiny?
Yeah, I think it's an important alignment point because there's a lot of people who probably don't want that level of scrutiny and prefer to go with a very less sophisticated private investor who might be through network and knows them and is happy to take that risk. And I think more often than not, that's where a lot of money does come from in these smaller deals. I guess if we talk a little bit about debt then, right, raising debt capital, what do you see as the main facilities in the UK for that? If you're running that 500K to 5 million EBITDA company and you want to raise, a substantial sum of money, north of 500K, what are the options that you typically advise on?
So I'm going to make this comment with the proviso, which is unequivocally, I am not a broker. However, the recommendation I give to all of my clients is the first person you should speak to when thinking about debt is a broker, someone with a real understanding of the market. It's very easy when you're trying to raise debt. The first port of call you're going to go to is whoever is doing your business banking. 99 times out of 100, they will be the wrong person to speak to. It's about understanding what you're raising the money for. There are all sorts of organizations that lend money for specific purposes. All sorts are out there for asset finance. Are you buying plant machinery for your business? There are lenders out there that is what they do. Often they may have a better interest rate or have more flexibility in their product than other lenders who do more of everything. Growth finance. There are so many sophisticated tech-based lenders out there now who offer growth finance, where it's very much for very, very, very specific purposes, but it's a cleaner, easier, quicker way of raising quick capital to go and fulfill a purpose. I have a particular lender in mind that a few of my clients have used recently that will only lend money for either marketing spend or for the acquisition of stock. They are the only things that they'll lend money for. And the interest rate looks really, really high. However, the way they get repaid is they will take, I can't remember what it was, I think it was 10% of your daily turnover until their loan is repaid. Now, it works as a drawdown facility because you've got a constant access to this overdraft, which is constantly being repaid. And the interest might look high, but you're never borrowing for that long.
Yeah.
And if your margin can beat the interest, which if your margin can't beat the interest, what's your business doing?
Yeah.
As long as your margin is beating the interest, you're making profit. And it's providing you that quick access to the quick deal.
Yeah, that's great. I mean, I think that's something that I don't see a lot of companies, and indeed their finance departments actually do, is they go, oh, we've got a NatWest, as opposed to...
The best people to understand the market are the brokers, the independent brokers who can understand what your requirements are and point you in the right direction. And I say, we work in professional services. Everyone's in the game because we've got to make a living.
Yep.
If they can introduce you to a better person to help you grow your business, it's worth paying the money.
That's the roundabout, right? I talked to all my clients about this. They started off, they didn't want to spend the money. Then they eventually spend the money. It's the same thing when you're looking at exiting a business. I've had a very close friend of mine go bankrupt in the process of selling his business because he didn't want to pay the right M&A advisory fees. And the reason you pay for M&A advisory fees is vast, but primarily you give it to an expert who knows what they're doing so that you're not going to lose focus. And it is a cutthroat world out there, and you do have experienced acquirers who will take you on quite a ride to distract you from your sales, to continue sort of pushing the boat out, and eventually you don't hit the revenue targets that they wanted you to hit. And in fact, you not only miss the revenue targets, but your creditors come in.
Yeah, I was on a call with a corporate commercial lawyer this morning who said that a comment to me was that the real value in the lawyer in a corporate transaction really is only in the warranties. So the warranties are the bits that you say, if this happens, I'm going to give you some money back. Having a lawyer on your side, making sure that the warranties are reasonable and commercial and not getting them wrong. I mean, you need to... Everyone doing a deal with an investor in their business needs to look at who the investor's lawyers are. If it's a name you recognize because you've heard them in the press and they're a big firm, you need to weigh up your lawyers compared to their lawyers. Because are they on an even footing? Are they dedicating the same amount of resource and thought power to making sure that if that eventuality happens, who is carrying the risk? Who is sitting on the risk for that?
Yeah, that's a really potent insight. Although the argument I'd play back is, knowing a lot of these owner managers, they just don't care. If something goes wrong, well, they're going to look. If something goes wrong, I'm screwed. I'm not going to get worried about being sued because I'm done for. I think that's probably the reason I mention this, isn't to kind of be provocative, but to kind of say, look, I think a lot of people need to change their tone and their view on it, because you do need to invest in the right advisory and have the right contracts so that you're not sort of operating your business like a cowboy. Experienced investors who have lots of money, who do have expensive lawyers, have lots of money and expensive lawyers for a reason. And I think it's really important that if you want to step into the big leagues and get conviction from them and not be taken on a ride, you need to have a similar approach to how you run your business. And I think that's the sort of transition between a bootstrapping entrepreneur and an experienced operator. And I don't really know how else to tell people that, besides saying that I've watched a lot of people lose lots of money over the years through just kind of having too much of a risk profile.
Yeah, and even setting aside the investment piece, it's all business owners can look at a balance sheet and understand where the numbers say the value of their business is. You've got your debtors, it's who owes you money. You've got your cash. We all understand cash. You've got your creditors you owe money to. You've got your fixed assets. You've got your profit. It's not that complicated. But that balance sheet is not a true reflection of the value of your company. That's a book value of your company. The true value of your company is, where is your business really generating its profit from? Do you have particularly valuable client contracts? Particularly lucrative client contracts? Do you have some really, really good IP? Do you have really, and this is what we see more often than not, do you just have really, really good staff? Do you have really good human capital in your business, which is really where they really work on the relationships with your customers. They really deliver a top-notch service. And it's fascinating looking at these businesses that are high, and we see this so often, highly, highly profitable. And they might have 30 or 40 staff that, really, if you fundamentally look at it, they're the reason this business is generating £1 million a year of EBITDA. And you ask the question and say, well, show me your contracts of employment. And everyone is on a standard template contract of employment is released on a template from 2001 that hasn't dealt with any of the latest legislation. And you're kind of like, well, that's your real value. And you've invested nothing but 150 quid on a Google download on some template that you've stuck the name in the top of. Like, what's your... these are the sorts of kind of, it's not going to cost a fortune. You've got 30 employees. It's not going to cost a fortune. Get an employment lawyer to do some proper contracts. What are you doing to incentivize your, what thought have you given to incentivize your value? What thought have you given to incentivize these staff?
Yeah.
Yeah, and these are the sorts of things that an investor will value. An investor will sit and say, okay, well, we've looked at your business and we think that your customer book, we're looking at your customers. You've got some great, great, great customers. You're making a lot of money. What do the contracts look like? What are your cancellation periods? Oh, we haven't done that.
More often than not, yeah. Yeah.
But that's the value of that's what they're going to value. That's what you should be valuing. What comfort do they have? And it's these sorts of things which drive up the multiple of EBITDA, which people will be willing to pay. The higher multiple of EBITDA, if you're looking to raise £1 million, you've got £1 million EBITDA business, you're looking to raise £1 million, your multiple is 4x because you haven't got good contracts in place. You haven't got good systems in place. You're giving away 25% in order to raise that £1 million. Put those contracts in place.
And what's that going to cost you?
Put these processes. This is going to cost you, 20, 30 grand maybe? Yeah. Now you're looking at going, right, I've got these. The investor's going to sit there and look at, okay, that's an 8x multiple business. I'm now going to do that £1 million investment, but I'm going to do it for 12%. These sorts of things, yes, it's money. Yes, it's money you've got to spend. But these things have so much more value than the cost.
Absolutely. I couldn't agree more. I mean, that's half of the work that we do for our clients, right? It's going in and looking at where the value is, is it in long-term recurring contracts? And again, it's highlighting the risk factors. If your team is a good thing, or even more importantly, if they're a problem and you don't have the right contracts, you can't really offboard them. And you get sued left, right, and center for it. Have you got the right insurances? That's another big one. No, we just bootstrap. And again, I forget the name of it, but there's this pyramid. There's a pyramid which basically explains how to grow a business from scratch. And the first layer is get profitable. The second one is get legal. The third one is get ethical. And it's quite funny, but that is how a lot of these businesses came about. And I think you're totally right. If it's 20 or 30K, and I think the most potent example you gave there is if somebody's going to invest £1 million to buy 20% of the business versus £1 million to buy 8% of the business, and the spread is way bigger than the cost of you doing it, it's everything.
Yeah.
But I think that leads us on nicely to once you have raised that capital. So you've done all the hard yards, you've gotten things in place, you've got your plan of action as to what you're going to do with the money, you've got the right resources in the right places. What are the most, important things to think about when managing cash flow post-raise for businesses?
So I'll preface this with cash is king, and it's always going to be king. So I think this is where we can look at what bad looks like, what good looks like, and what great looks like. Mm-hmm. Now, I'm not always saying you need to be great. In some cases, good will be good enough. Having an idea of what your burn and your runway looks like is really, really, really important. And once you have closed an investor, it's highly likely you will have made, I don't want to say promises, but you would have told an investor what this is going to look like post. Yep. You want to keep a tight handle on that. It's far too easy to burn through the money in your pocket far too quickly. You want to make sure it's going to, what is going to deliver you a return. Now, for most small investors, good will be enough. So good is going to be a 12-week, 12-month cash flow forecast. It's going to be good processes on working capital. If you've got good processes on debt collection, you can be a little bit more. You've got good processes on debt collection. You normally would have better working capital. Better working capital means your cash works for you better. You want to keep an eye on it, but you're not sitting there constantly watching the pennies because you know that there's cash flow coming in. Often that is sufficient. Your investor might want to see a little bit of sensitivity. We've got a project, we're investing 100 grand into that project. We are expecting that to deliver 100 grand year one, 200 grand year two, 300 grand year three. Okay, but let's look if we're wrong on that assumption and we're 20% below. How does it look? How does it factor into our cash point? Are we going to have any pinch points? Is there any seasonality? That's good. Great is when you look at the data underlying it. So you might look at different ways of making your forecast. You might look at a forecast based on your resourcing capability. How much turnover are we resourced to deliver? You might look at a CRM. You might be building in a pipeline for future opportunities.
Yep.
Build that into it. How does our CRM turnover forecast compare to our resource turnover forecast? It's great having a CRM that predicts 50% turnover growth, but it's not great if your resourcing capability can only deliver 10% of it. How are you meeting that shortfall? You can look at sensitivity into both of those different models to see how it all factors in. And it's in that aggregation of different data points and overlaying all of those opportunities and overlaying all of that trend analysis that you can sit there and spot and make much better tactical decisions on how you grow. Because if you spot a resourcing shortfall, now is the time. Resourcing, if it's human beings, doesn't happen overnight. You need to be preparing for that in the future.
Yep.
But you rely on what the data is telling you to meet those shortfall points. And often where we see corporate investors, and I know we talk about the downside of having a pain in the private equity board member on your seat, but these are the sorts of things they want to see. Because it's great saying, I'm going to go out, win loads of new work. That's great. Who's going to do it?
Well, it all comes down, as you said, strategy and systems. How are you going to make it happen? What does good look like in resourcing, etc.? But then the systems that enable you to have the right insights and also shave time out. And I'm wondering, actually, probably an important question on this is, do we create all of those systems, or how much of that strategy and systems work do we do before that capital is raised? Because bearing in mind, most companies won't have an amazing version of that going forward.
Absolutely right. And I would like to make a suggestion to everyone, which is that if you are getting a corporate or financial institution as an investor, part of the budget of your fundraise should be dedicated to a data analytics improvement project, whatever that looks like for your business. Part of your budget should be dedicated to how am I going to make better use of my data through the, say, 5-year journey to the exit.
Yeah.
Data is incredibly important. And again, I'm thinking back to what that eventual exit point looks like, because if the end point for you and your investor is an exit in 5 years' time, who is going to be your buyer or your investor then? Because even if it's not a financial institution now, it might be then. And they're going to want to see, and financial institutions, private equity especially, value the data that a business is able to access and make useful information out of to make business decisions. And investing, very, very few large investors will object to you spending some of the investment you're raising on better data or better use of your data.
Yeah, absolutely. Again, so many lack it. I'm glad you said sort of data analyst, data engineer form of project, because I find a lot of small businesses have small accounting firms that they use, and often it's pretty much fully outsourced. So it's the bookkeeping, payroll, sometimes it's even down to expense account management and that sort of a thing. But they don't typically have the digital capability to support a transformation. Again, I'm going through, I think at the moment, three transitions or 3 transformations right now. from a sort of rudimentary accounting software to a zero or a QuickBooks. I think in both cases it's zero. In all the cases it's zero. The accounting firms that are doing that transition don't have the resources or tech capability to do it. And because of that, it's taking weeks and weeks and weeks to do something that should take a couple of days. And I think it's really important if you're a business owner to just be honest with yourself to say that, have I outgrown my accounting firm? Have I outgrown even some of the staff that we have in the business? Because it's a commercial decision. If that's going to hold you back from raising the capital or driving growth through the capital, you need to think about that. A lot of people say, oh, no, we've been mates for years. I'm going to keep them on. They said they can do it. It's a bit slower, but I'm happy. You're eventually going to have to switch anyways. Why not switch now?
Yeah, we see it quite often. We see a lot of owner-managed businesses that have been lifestyle businesses for the business owners for decades, and now they're looking to get some value out of it. Often with these ones, we're seeing it as more of an exit rather than investment. But even with an exit, you've often got a deferred consideration. You've got earn-out targets. So they're still invested in working in the business for a few years after to make sure they're maximising their value out of it. And the requirements they had for their administration, financial, operational teams are very different to what the new business owner has. Great example of this, we had a client that sold out to a trade buyer. Great. They were very happy with the deal. The trade buyer was very happy with the business. It was a really, really nice synergy. It's going really well for all intents and purposes. However, even at a compliance level, the trade buyer had a reporting to its investors on a monthly basis. It had big institutional investors that required to know on a monthly basis how it was going. Its finance team required the financial information from all their subsidiaries within, we call it T+5 days after the month end. The issue we had with that was that the financial controller in the business they bought only worked Monday and Tuesdays. So if the month end fell on the wrong day, they weren't able to deliver the financial requirements to parent co. Mondays and Tuesdays were fine for the size of business based on what the financial reporting requirements, what was required for that business provided. It was profitable. It was cash generative. It was fine. But the requirements of the new business owner, it just didn't work.
Yeah.
And there was a shortfall that needed to be bridged. And fortunately, in that case, it was able to be bridged. But it took some thought. And the financial controller that's working 2 days a week in the business is still working in the business, doing the same thing that she was doing before. But there now is an overlay process so that the investor is able to get out of it what they need.
So that's where you're supporting them on, is it?
We are in the process of supporting them through that whilst they look for a internal scale, whilst the investor is looking for an internal option. We believe they have a number of businesses they have acquired in a similar position, and they are now going to bring someone on as a coordinator for all of those part-time finance professionals. So
do you guys go in and kind of, I wouldn't say the word is restructure, but put those systems and processes in place, and then sort of until they've recruited or insourced the right person?
As I say, a lot of what our fractional finance offering does is that sort of project work. There is a requirement due to a transformation, due to a transaction, and the process of finding someone in-house to do it either does not represent good value for money or is going to take too much time, but the need is now. And we will go in and we will meet the need, meet the requirement, keep everyone happy. And we're very happy working on these temporary contracts.
But I mean, that speed is everything, I think, in these things. So I was having a conversation with a client this morning about this, and I said, you need to get another operational person in your business because you want to get to this point by Q4. Based on current trajectory, it might be Q4 next year.
Yep.
If you don't get sick, go on any holidays, or have a bad day. So I think it's really important. And again, it does cost more money, but I think a lot of the key insights from today is you have to have the right systems and processes, but putting those in place isn't simple. You've got to have the right people to do that. And then you've got to have some sort of a temporary fix initially to deliver, whether that is a fractional expert or team in there. And as you said, from an investment standpoint, no investor is going to look at that as a negative. maybe that, maybe I might look at it and go, well, they should have had that in place already, but let bygones be bygones.
They got to the point where they needed to be.
They got to the point where they needed to be.
No, exactly.
So besides sort of systems, processes, having a plan in place, is there anything else to do with, managing cash flow and burn rate that would be useful to highlight? Trying to think out loud here, but we've gone through tools, we've gone through prudent cash flow management, dashboards. Is there anything else that we would want to raise?
No, I think the only thing I would say is through many years of learnt experience with clients is where a potential issue is forecast, giving yourself as much time as possible to be able to pull the right levers in order to get through that is essential. It's very, very different finding out you're going to have a cash flow issue in 12 weeks' time than it is to finding out you've got a cash flow issue on when payroll's paid next week. Giving yourself as much time, having as much, the more time you've got, the more levers you've got to pull, the better the conversation will go with your bank or other lenders saying, I've got this period, I need a short term, this is the amount I need to get through it. You don't want to be going to your bank saying, I'm in my overdraft, it wasn't arranged. You want to be going to your bank saying, in 12 weeks' time, we think we're going to be going into our overdraft. We'd like to talk to you about what you can do to help us.
Yeah. I think on top of that, then, it's really important to have all of the departments connected. So I go to a lot of private equity investor days where they talk about the new raise they're doing, the progress over the last 6-12 months, the exits they've had, and they talk all about all the classic stuff, EBITDA multiples, increasing value through operational efficiencies, etc. But the only talking point operationally they ever touch on is the finance department. And whilst, as we've discussed today, is super important, connecting that to operations, HR, marketing, and then the wider tech stack of the business is quite important because as you said, from a resourcing perspective, if you do find that there is a potential issue in your pipeline or in resourcing, you need to be able to, and our dashboards start flashing red about that. You need to be able to actually go and remedy that. And you can have the best financial systems in the world and a good CFO, but if that isn't then fed back to the wider team and then actioned, it's almost a waste of time. Because if you can't sort of put capacity in before that bottleneck, you will hit the bottleneck and everything falls apart.
I have an interesting view on it's the departments which are traditionally run by the members of the C-suite. So what you meant, the COO, the CFO, the chief digital officer, chief people officer, whatever you want to call them, they all exist on a spectrum of risk and opportunity. And what's very interesting to see in different businesses where they have that C-suite is where the business views that department or that individual, that chief of, from a opportunity generation versus a risk mitigation point of view. The most successful businesses that we see have more of their C-suite within the opportunity, that kind of optimistic, all of these things are going to deliver results for our business. Those that have them more pessimistically in the how are they going to help us mitigate risk. And really, it comes down to the resources of those teams. What are they doing? Are they delivering you opportunities or are they mitigating risk? We see a lot at the moment. I would turn around to every single business in, I was going to say the UK, but I would take this much, much wider. The highest risk part of every business at the moment is cybersecurity.
Well, we've seen in the last, couple of months, big brands, even the big ones, the ones that shouldn't have happen.
Every single, I'm not going to speak for all of them, but if you were to get 100 chief digital officers in the room and you were to ask them, what are you focused on at the moment? I would say 99 of them are focusing on cybersecurity and risk mitigation at the moment. Tech stack, yep, very important. But to us, our biggest risk is cybersecurity attack. The one who's not focusing on it is probably because he's just handed in his notice and he's waiting to start his next job where he's going to be thinking about it. But it's an interesting point on what those departments need to be focusing on, where even within those departments, it's great to have a chief marketing officer who's focusing on new opportunities and isn't sitting there worried at all about, Are you working for some particularly untoward clients that maybe some news stories might come out about, and do you really want to be attached to that sort of business? That's what the chief marketing officer's job is to do both, but they're going to be mostly focused on the opportunity side. The chief digital officer is going to be focused on the risk and less about the opportunity at the moment, just because it is very, very topical, the cybersecurity risk. How are those departments working together where you've got one going, yeah, let's go, let's sell, and the other's going, let's be careful. And you talk about aligning departments and that process behind it, but that highly strategic level of balancing risk and opportunity is a big thing in business at the moment, especially where you've got investors, where you've got institutional investors especially. And the institutional investors will, and this is probably one of the reasons why people don't like having a institutional investor with a board seat, because the institutional investor will always go down probably more the risk side than they will on the opportunity side. Now, they're not wrong, but it's about keeping that balance right. And it's about aligning the strategies of the different parts of the business to make sure that, yes, if you've got someone who quite rightly is focusing on risk mitigation at the moment, they still have that eye on opportunity. But likewise, if you've got someone who's all go on the opportunity, they've still got their eye on, well, what are the risks we're taking and how do we mitigate them?
I mean, as a business grows, I think this gets harder to do because each department typically gets a bit more siloed. They get bigger, they get into their own management processes. And when working in large companies, I found that problem, which is there's a huge financial risk in the business because one of the departments, let's say you're a B2B and B2C company, you're a retailer, your B2B department is underperforming and is not growing at the rate that you've promised in the reports. And that's due to something that's in logistics, in the logistics department. But logistics doesn't speak with finance or marketing, and they all blame each other for it, and there's no productive sort of output. So what I'm saying is it's good to have a good finance function, but if those insights aren't leveraged and continually plugged back into all of the departments, it's a waste of time. And as you grow, this gets harder to do because everything gets a bit more busy and siloed. And I wish I could kind of put that lens of thinking into the room of a lot of these private equity value creation strategy, 100-day plans, because it's all about the finance function. And it's I know there's less impact on the balance in the numbers in the short term for going into ops or tech, but the long-term impact on EBITDA multiples can be quite big.
Absolutely. I think it comes back fundamentally to the good quality of data. And to go one step further on that, it's then being transparent with the information you're generating from that data internally. Completely separate podcast that could be done about sharing internal data externally, but sharing that data internally between the different departments in such a way that shows where each department interacts with the other and why they are all symbiotic to the ultimate success of the business. And having a complete transparency on it will give people their accountability for their part of the process. It's very hard to hold a team accountable for something if they didn't know they were the problem. Because it wasn't being communicated with them. And having that full transparency amongst everyone, you can be dictatorial and authoritative on it and saying, you are the reason we have this problem. But that holds less weight than when you have the entire process mapped out in data, in useful information that is showing where bottlenecking is occurring, where things are not being delivered, where, the average SLA, internal SLA is 24 hours, but you've got one department running at 72. If that information is entirely transparent, you don't need to be authoritative. You don't need to turn around to them. Well, you shouldn't need to turn around to them and say, guys, you're the problem. They can see they're the problem. And if that isn't improving over time and they haven't come to you with a strategy, say, look, we know we're the problem at the moment. This is why it's happening. This is what we're going to do about it. That's when you then step in and say to them, look, everyone can see where the problem is occurring. What are we going to do about it? And it's in that transparency, and that comes into the people point, which is a good culture. And for me, transparency in any business is absolutely key to having a good culture. Having that ability between departments, between staff members, where everyone knows and understands how essential they are to being part of the machine.
Yeah, and on top of that, I think it enables you to hold people accountable as well. And that's ultimately the most important thing, because there's always going to be a blame game played if something goes wrong. And if you've got clear lines of accountability and people know they're on the hook for things, then everything works. And I think especially when you've got the scrutiny of investors, or you've got the liability of debt that's going to come and the bank will come and get take you to the cleaners, so to speak, to get their money back. I think it's really important to consider those things. Just thinking again, summarizing a lot of the key insights today, financial systems are really, really important. They are not a cost, they are an investment, as is the right financial advisory for a business. And I think wrapping this all together, it needs to be plugged into the operationality of a business. So where do you want to get to? Where are you now? What does that plan look like? And how do you put the right resources in place other than just capital to execute that? And once you have all of those things together, things start to work miraculously. And I think what I would say, and this is probably a bit savage, but most companies don't do this well, which is why quite a large percentage of owner-managed businesses do fail. If you look at the statistics, it's big. I think it's really important to take those things away from today, if nothing else, is to really scrutinize your own finance department. If you don't have one, that's in itself probably a bit of an issue. Again, not all businesses necessarily need one, but the ones that we speak to, certainly. And if you want to raise capital, get advice from an expert.
Yeah, no, I completely agree. And one little add-on I will say is what you should be getting from your finance professional, be it internally or externally, is it's great to have loads of data thrown at you if you're of a particular sort that loves Excel chart and data tables and that.
Yeah.
What we find much more useful is how can we distill the performance of this business into a live KPI? What are the, I as a finance professional I work with says, what are the 10 KPIs that really tell you about the health of your business? And you might track them on a daily, weekly, monthly, annual basis. And as long as they're going in the right direction, that's fine. I think 10's too much. I think that's too much information. I think it's really, what are the 3 KPIs, 3 key, real key statistics in your business, which if they are good, the business is going in the right direction. And that's part of what often we will look at in preparing an information memorandum, preparing that, maybe not for the information memorandum, maybe for the piece afterwards, once you are talking to the investor about when you're selling, what does good look like? And you say, these are the 3 key KPIs. These are the absolute fundamentals. This is the target. This is where we're at. This is the point where the green light starts flashing yellow, and this is the point where it starts flashing red. These are the real key points. And fundamentally, they will tie back into the numbers in your forecast, which is the big ones: profitability, cash.
Yeah. Again, I think the point you're driving there is also the live element of it. So having, if not a live element, but a consistent weekly or daily report of that. And a lot of people actually struggle to get that. It's like a baffling amount of companies don't have that. You mentioned T+5, was it? In most circumstances, I'm seeing T+90.
It's not uncommon.
And the other thing that I find quite interesting, maybe a little bit off topic or tangent, but everyone asks for management accounts because that's the thing to do. But what they don't do is sit down with their advisors or accountants and go, what are actually those 10 things that I need to be tracking?
Yeah.
If you're a hospitality business, it's probably not going to be something Xero can track. You're going to have to go through your Square terminal or your Toast terminal and find, what burgers were selling the most this week or which site was performing the best. And
absolutely.
You've got to define those and to the best of your ability have them live.
And management accounts often will follow a standard accounting template, which is absolutely fine. That's what they're there to do. It's there to track profit, turnover, cash, debtors, whatever it might be. But they are not built for each business. The whole point of the KPI track is they are highly tailored to your business. They are the KPIs for your business. Different industries will have certain typical KPIs. I mean, hospitality, I do quite a bit of work with hotels. We'll look at the average nightly rate of a room. Over time, we'll track it during the seasonality of the periods, compare it to the equivalent time last year, etc.
Yep.
Each industry will have its own one, but there is more value in that data than there is looking at what happened last month in your profit. If you get your KPIs right, your profit and your cash conversion will follow.
Yeah. Well, leading and lagging indicators, right? It's really important to track those. And if you don't have a expert helping you with that, then don't know how you're supposed to do it. It's tough.
Every business can get there.
In the most basic sense, the quickest piece of quick win advice should be go on ChatGPT, explain to ChatGPT that they are an expert accountant from X accounting firm, and give it all the data you can. You can create a custom GPT and upload all the data about your business, give it the website, give them your profile, give them your last year's report. You can even link your zero in if you wanted to through PDF, and ask it, what should my KPIs be? And then play around with it. And you will probably get to a point where you've got semi-okay KPIs, and that's probably for the companies who don't want to invest or want to get a taste for it. I think the challenge I see with companies is when they don't have a live dashboard, it takes human input. And if human input is required, sometimes people, for their own self-preservation, smudge the numbers, especially in sales statistics. Leads, inbound leads, how many of those were closed, why they weren't closed. Those are sort of the...
But again, this comes down to the systems you use. So if you're using a CRM process, a CRM product, whoever it might be, there are lots of products out there on the market, you will have data from that. A lot of, in Zero, you might not have the perfect data, but you will have data from that. If you're using, it depends what industry you're in. You will have access to an awful lot of data. It's what you do with that data. One of the things we're looking at with a lot of clients at the moment is how we build, it's not artificial intelligence, it's automation. It's how do we automate systems? How do we automate data coming from various points into a single point? A data lake is what the scientists call it. And then they have their own analogies. I like, how do we then go fishing for the right data out the lake? But how do we get these systems to talk to each other so that we can pull out what these statistics, what these real indicators of how your business is doing really are? You're not doing yourself any favors by fudging your data or by fudging your results.
No.
It might make you look better, but fundamentally the whole point of the KPIs is they will eventually find their way into your accounts, and your accounts will show you might have said that you were delivering X% growth, but you've only delivered half X. So there's no point fudging it, because fundamentally when it comes that decision, that kind of real transformative moment, I'm exiting the business now, I'm getting my money out, they're not going to look at your KPIs. They're going to base that on your accounting profit. They'll then sit there and look at your KPIs and say, well, your KPIs clearly weren't that accurate because they said your accounting profit was going to be X, but actually it's half of that. We're now not going to value your business as a business that makes data-led decisions because your data collection isn't good enough. So it all comes back to credibility. It all comes back to the reason your KPIs exist is to help you make better decisions, not to show everyone how well you're doing.
Yeah. And in terms of the system that goes behind that, so you mentioned data lakes, is this something that you do for your client base, or are you looking at this more from an internal project standpoint?
Both.
So you will help UK businesses, international businesses with their financial systems, with automation in them, and you'll do that mostly in-house?
Yes, to an extent. So we will provide the consultancy on what the KPIs should look like. And we work with experts in the data science field who would build the actual architecture that can deliver it.
Great. And one other question on that then, because getting paid on time is a huge issue for, I would say, the majority of businesses, especially B2B companies where it's backs, right? It's not direct debit, it's not credit card payments, it's backs. And you mentioned also, 3 ways, I think 3 or 4 ways at the beginning of this, how to raise money, how to get money in. And you said the one that you would start with is looking internally and going, where is waste? Where are we not being paid? Would you mind telling a little bit about how do you go in and take a business that maybe is having majority of payments late? How do you solve that as a problem, high level?
So at the highest level, the most important thing is have a process. So have a contract with your customer. The contract should set out what the payment terms are.
Yep.
At least now you've got a point of truth that you can refer back to and say, look, our contract says 30-day net monthly, whatever it is. It doesn't matter. You want to get it as short a period as possible, but it doesn't really matter. The point is you've got an agreed point. There is something both parties have signed, which says this is the service we're going to deliver. This is the product we're going to deliver. This is when you're going to pay us. What you then do is you build the process. So invoice goes out. That starts a timer. Say you've got 14-day payment terms. 7 days after the invoice goes out, a first reminder is sent, just reminding you, this is a copy of the invoice. It's due 7 days' time.
Yep.
On the day, just reminding you, this invoice is due today. 7 days after, just reminding you, this invoice was due 7 days ago. At that point, I would probably then say, okay, this now, they haven't responded to it. This now needs to be escalated. Yeah. What is the next level of escalation? You don't want to escalate it all the way to the top. You want there to be a reason, because you're not looking to burn the bridges with your customer. You want the customer to come back. Or maybe you don't. In that case, you can escalate all the way to the top quite quickly. But you want the customer to come back. So what's the next level of escalation? Perhaps it's now the finance person calling the customer and saying, well, just by the way, I noticed, the invoice is now 7 days overdue. Just wondering what's going on. It doesn't need to be an aggressive call. It's not a pay us now. Yeah. It's just a friendly, guys, just making sure if you receive the emails. 7 days more goes by. Now what do? Well, you now need a next level of escalation. And you kind of look, the end point we will get to will be and it won't be the end point, will be the final legal letter where you sit there and say, if you do not pay this, we will be passing it over to our solicitors. We are not happy about it. You are not going to be happy about it. But one way or another, we're getting our money. But it's having that escalation, that completely reasonable escalation process. There's very good reasons. And, it's fine if I do this with my clients all the time. A client might call me up and say, look, I've got a big deal going on. I'm going to get paid at the end of next month. Can you give me some time? Yeah, of course I can.
You make an educated...
I make a decision on it. Would that's fine. You owe me $4,000. You've got a deal completing in a couple of... Would it be all right? Can you pay me £1,000 now and we'll do the $3,000 when the deal completes? Is that all right? It's being reasonable. And at some point in the escalation, it will be the head of or the account manager or the business owner will call up their client. And often it will be the finance team at your customer who'll be receiving the invoice. You won't be paying it. And eventually, principal to principal, you'll sit there and have a conversation and say, look, mate, I've done the work for you. Were you not happy with it?
Yeah, I mean, that's the bit that you don't want to get to. But, I've probably spoken with over 100 companies over the last 90 days about this problem because it's such a big problem. And most of them go, you know what, it's actually our best customers who normally don't pay on time. And we're talking about large institutions that aren't paying on time. So it might be a catering business or a hospitality business that is way overdue, their own money. And typically they just say, look, it's because the client has changed financial systems, somebody's left, or they themselves, as you said, are waiting for a large payment. And 9 out of 10 times you get paid on time. So I think in some instances it's very difficult. But you're right, a lot of companies, or I would say own and manage businesses who specifically don't have expert financial analysts in their businesses, they struggle with prioritizing what, let's call it, debt needs to be collected, cash collection, credit control. Speaking with a client about this a few weeks ago, they at any one point in time got about 900K late. And the problem with that is they've also got more than 900K payments to make to people sometimes. And they didn't have data on who they owed money to and how much they owed. And, you can find it in Xero, but it was scattered. And I think if you just sit down and do a simple prioritization exercise, sometimes that's all it takes.
Yeah, I particularly love the looking at the contracts piece. So often you will find that larger companies might turn around and say, well, we pay all our suppliers 30-day net monthly, 60-day net monthly. It's quite common, isn't it? But then you sit there and say, okay, but we've signed a contract that says 14 days after invoice. How come your purchasing manager signed that contract? Like they've signed it and agreed to our terms. If you'd have told us that your payment terms are like we've got a legal contract here. So help me? Like how do we how do we reconcile this? Because you've signed, someone was empowered to sign this contract. Yeah. How are we gonna sort this out? And often that interestingly opens up. I quite enjoy this. I quite enjoy helping clients with this conversation because often that actually opens up a really nice opportunity with that client because they're now saying, well, my hands are tied. My hands as the customer are tied. Our policy, I can't go against our corporate policy to pay you 60 days. That contract shouldn't have been signed. That contract, it should have been made clear to you. Help me. Someone's in trouble here. Help me. And often that's a nice opportunity to go out and win some more business from that client.
Okay.
So, you know what? That's fine. We'll change the contracts. But we've now signed for X more, £50,000 more's worth of supplies coming next month. We'll sign that contract on your payment terms. We'll do it 60-day net monthly. However, there needs to be some quid pro quo for me. What's my quid pro quo? You know, we've done £50,000, but we've given you a 10% discount. Let's reduce that discount to 5% because we're meeting you in the middle.
Yeah.
It's that conversation which, by being the reasonable party, by making it work for someone else, you can often get a little bit more out for your own business from it.
And it all adds up too. It all adds up. And I think going back to the whole why should you outsource or bring in a team to help you get there is, again, I have clients who are a little bit behind on their credit control because they're just too overwhelmed. And again, that's why they've hired us. But in that sense, is it not worth paying somebody to come in and organize that for you so that you know who owes you money, to do the chasing, and then for that to get wrapped up in the next 2 weeks as opposed to spend the next 8 months chasing?
100%.
You know, even one of the smallest businesses I work with, you know, I think they're only doing about 250,000 EBITDA. They found something ridiculous, like I think 45 grand over the last 6 months that just wasn't collected and just got lost. And this wasn't 45 grand in like £1,000 payments. This was like 50 to 100 quid call outs for a small construction business to go and fix whatever. And that mounted up to that much money. And we realized that was a systems problem. So this is where it comes back to connecting everything, all the departments, all the systems, because then there's, you know, it's worth a lot of money. It makes life easier. You're confident things aren't falling through gaps. And then when you do go to raise money or sell your business, there's more intrinsic value.
One little story I'd like to tell on that. Beginning of April 2020, like many, I was working from the dressing table in my bedroom, and I arranged a webinar with a group of my clients who, smaller clients, you know, lifestyle businesses, kind of 100 grand EBITDA businesses.
Yeah.
A lot of them are contacting me saying like, business is falling off a cliff. I've got nothing. I'm doing nothing. Like everything's shut down. I don't know what the future's going to look like. What shall I be doing? So I had a webinar, and I think I had about 10 or 12 people join it. I did about 50 minutes. I just said, right, if you've got nothing to do, this is what I would do. And my first thing to every single one of them was spend your next week calling every single one of your customers and start from whoever owes you the most money down to the least. And your conversation should not be, you owe me money. Your conversation should go going, how are you finding this? Is everything all right? Come on to the point of, oh, actually, you know, you still owe me for that invoice. Would it be all right if you transferred it? And then you go on to the ones, and you generally talk about it. And it's funny because about when we came out of that lockdown, so it must have been around July 2020, a lot of those clients I'd spoken to again, and none of them, every business survived, and be it through the recovery schemes that were available, the loan schemes, whatever, everyone was fine. I spoke to those clients, and they had two observations for. First thing they said was, I collected more money that week than I ever have in any other time in my business career, which was very nice to hear, because in that period, it was all about, let's just have the money in your bank account.
Yeah.
The other thing they said is, I generated so much new business 3 months later, just from spending that time contact, even though it was fairly thinly veiled that what I really wanted was them to pay my invoice. Just is everything all right? How's business going? Anything I can do to help? But by the way, you owe me a bit of money. The value that was generated from that, a lot of my clients were very, very appreciative. A lot of their customers were very, very appreciative of just someone being in contact, finding out how everything's going.
So they won upsell work, or they got referred?
They won upsell work, referrals. It was just a relationship building exercise. Yeah. To be honest, everyone was at home. It wasn't like they had anything else to do.
Yeah, it was a special time. But I mean, I say the same thing to, got an accounting firm as a client right now, and I said the same to them. I said, when was the last time you did a price review, or forget about a price review, when was the last time you looked at every single one of your clients and thought, is the contract and the current agreement correct for the size of their business? And they went, I haven't actually done that once for any of my clients ever. And I was like, well, that's £2 million right there. I said pretty much the same thing you said. I said, ring them up, see how it's going, ask for feedback, give them loads of value, and then drop it at the end. By the way, looking at your growth, as you grow, we want to grow. We're a little bit imbalanced here, and nobody's going to argue with you over that.
It was an interesting point because you say give them loads of value. Value doesn't include any sort of professional advice or do any work or it was just let them know you're there. Let them know you're thinking. You're a significant enough priority to them to be worthy of a contact during what is a very difficult and uncertain time for everyone.
Yeah, I know it was a weird time, but I think those are some really potent insights today. And it's been a really interesting conversation. I think we're going to get lots of good feedback from this. Hopefully people will share, and this will help a lot of business owners out there. Until next time, Jason, thanks so much for joining.
I hope so. Thank you very much for having me.
Cheers.